And welcome to another edition of the Nerdy Agent Podcast. I'm your host, Luke Pettersen, with my brothers and fellow nerds, AJ and Josh. Today we are going to talk about the future of interest rates. No, not the overnight rate that we've talked about probably way too much on this podcast. The interest rate that you actually care about, the 30-year mortgage rate. But first, the Would You Rather of the week, which I came up with this one on my own, editing another Would You Rather, and I personally think it's interesting. Would you rather own a home that
Wait, is it interesting?
It is. That's what
Ooh, I like it.
that was the pun. No, I'm kidding.
I know the answer to this question right away.
Would you rather own a home that is only accessible by a 45-minute boat ride or by a 15-minute plane ride?
Boat. Plane, no question.
1 hour boat ride or 15-minute plane ride?
Still the plane.
Wait, you're taking the plane?
I love being on a boat. Luke, I have a dreams of someday being a pilot and flying my own little float plane.
Oh, I didn't know that.
So definitely
You will never see me in that plane.
It will be a very fun plane. And in fact, at the cabin the other week, 3 float planes flew in and floated themselves at the sandbar. And I looked at all of them and was like, this is so freaking cool. I'll never own one because Emily will never allow me to. But
because if you ever see the bad headline, it's always person flying plane
or helicopter
themselves. Didn't go well.
Or someone in a car that ran into something.
A lot more cars than planes.
Yeah, well.
But this is a boat versus a plane. There's no car involved here.
We should do a 45
Have you ever seen the Murdoch story? Have you ever seen the Murdoch story? I'm pretty sure someone died on a boat in that story.
Wait, Josh, if
you're
it
not
was
drunk driving this boat.
Josh, if it was a helicopter, would it change your mind?
No, not at all.
I think I'd take the helicopter.
Oh, I would love to do a
helicopter
too. That'd be so fun.
I would.
Kobe scarred me on that.
It was the only person ever. All right, let's get into
That's not true, but
let's get into what actually matters. Let's get into what actually matters here. So a couple of weeks ago, it's story time. A couple of weeks ago, I was talking with our financial advisor, who just happens to be both AJ and Josh's as well. I asked him just randomly where he thought the 30-year interest rate would go in the next couple of years, just because I was curious. He's the one that tends to have a little bit more information. He's a really smart guy. And he said in the next 12 to 18 months, he said they'd be around 5 to 5.5, which I was surprised by, just based on what I've been seeing, but also based on what I think that would do to the real estate market, especially here in the Twin Cities, and that wouldn't necessarily be the best outcome based on what would happen. But I wanted to get into that today, talk about why he thinks that, what that might mean for you as real estate agents and listeners. So to start, what's this data that supports kind of what he's talking about here?
So the general gist of what he's saying, and like I said, Alex is very smart, and the reason why we're even kind of bringing up this, I don't say clickbaity topic, but headline, is because this is coming from a person who's a third party, not at all invested in the real estate market. This is not a lender. This is not an agent. This is just a financial advisor saying, hey, as you guys think about your money, this is where I think this is likely going based on what I'm seeing. And I'll be honest, as we go through this, I may feel a little bit differently. So we'll probably hear about that as well. But data-wise, his point is that as we've continued to see this huge ramp up in the overnight rate, that's continued to drive this huge ramp up in our 30-year mortgage rates. So now that the Fed has kind of gotten to a point where we're feeling like we're either at the top of the mountain or we're close to the top of the mountain, depends on kind of how data shakes out the next few months. When historically the Fed has raised rates have gone up on the mortgage side, but when they've paused rates have started to kind of trickle back down. And when they've started cutting rates, mortgage rates have also followed suit pretty quickly. So essentially, because our 30-year mortgage rate is tied very closely to the 10-year Treasury yield, what Alex is communicating is that he believes the 10-year Treasury yield is going to start moving backwards pretty aggressively within the next 12 to 18 months, and thus the 30-year mortgage rates should probably pull back as well. That's kind of the big
So you're saying the Fed has kind of indicated that they might not raise that overnight rate anymore at this point?
They have not said what they will or will not do. They have said the data will drive them, but the data is strong right now. And the gist of it is that most investors that are looking at what's happening in the marketplace and looking at what the Fed's doing think there's a outside chance there's another quarter point raise, but for the most part, most believe they're going to pause and then likely hold there for a period of time until we hear more data in the next row.
And historically, when the Fed pauses, it causes the 30-year mortgage rates to start coming back because the spread gets smaller.
Well, I mean, we've seen over time, and there's this beautiful graph that we could superimpose here. that when the Fed stops raising the rates or signals really, and this is what I talked to Alex about too, when they said we're going to raise the rate one more time, we might do it 2 more times, you see a lot of bond activity, which typically sends those treasury yields down. And again, typically there's a spread between the yields and the mortgage rates. And hypothetically, that's going to follow suit. So as you see that 10-year start to drop, you should, in theory, based on history, see the 30-year fixed mortgage rate drop as well.
And so I wanted to get into what would happen then if we got to this point. So in order to figure out kind of what that would look like, and I know that it's different than historically because there's a lot of stuff that has happened in the last 5 years that historically basically hasn't ever happened. But when was the last time rates were at this level?
So at this level,
Of 5 to 5.5.
yeah, 2006 was the last time that's closest to what we're experiencing today. Now, we were talking about this earlier today, and what we've seen is our run up from 0 to 5.5. This cycle has been really fast. So it's been a short window of time where they've raised rates dramatically. In 2004, 2006, they raised the rate from 1 to 5.5, so very similar amount, but it happened over 2 years. So it was about quarter point pretty much every meeting for 2 years. And so the way that impacted the mortgage rates, the other interesting thing about that point in time is when the Fed funds rate was 1% in 2004, mortgage rates were still in the low 5s. So there was a large spread between mortgage rates and the Fed's fund rate back in 2004, 2005.
Was there a larger spread then than there is now?
Yes.
Interesting.
And so what happened was rates jumped up. They went up to a peak of about 6.8 in 2006. And honestly, the interesting thing about this is the reason the Fed raised the rates in 2004, 2006 was because they felt the real estate market was overheated. Now, if you look at history, we've talked about the way the lending activity has changed dramatically from 2004, like pre-2008 and post-2008. That was probably why the market was overheated back then. But they peaked at about 6.8, and then as the Fed paused, we started to see the rates come back down. Now, they came back down to low 6s during the pause period into the rate decline period, but then we hit, 2008, which kind of changed the whole reality of what we were dealing with from an input standpoint.
So talk about what the market, so then in 2006 was roughly similar to what we were seeing from a Fed activity of the overnight lending rate. And we all kind of know what happened in 2008, but what were the numbers around the market and what it looked like then?
I mean, what kind of numbers are you talking about? The mortgage rates or the
transactions?
Yeah, I mean, the lax
Mostly.
standards in '05 led to 7 million transactions nationwide. It started to come down as the rates went up. Again, to Josh's point, it's similar to what we're seeing now. So 7 million in '05, 6.5 million in 2006, only 5 million in 2007. But for perspective, in 2022, we had 5 million and projecting 4.3 million in 2023. So
even at the peak of COVID, we were just over 6. So 2005 compared to our massive time frame, like it was nuts.
Yeah. So, we don't have a lot of what we're entering into, we don't have a lot of transactions already. A big reason why was, again, the difference between the two time periods is there was a lot of speculation going on back then. So tons of building just to sell, and they weren't even real buyers all of the time, and there was a bunch of nonsense going on. So the availability of property to purchase and the ease with which you could get financing can lead to a lot of buying, right? Just a lot of transactions. And now when, that all happened, we introduced some regulation, lending standards got a lot tighter, and, this whole rate environment we're experiencing and the massive jump in mortgage rates means there's not as many homes on the market. So you can only sell what's out there.
I would have loved to be I would love to go back in time and at least sit in on some of like those bigger, if there were big team meetings. I suppose there maybe were brokerage meetings at that point, like 2005, and see what they were talking about. Because in the middle of COVID at 6 million transactions in 2021, it was chaos for us. And so 7 is so much more than 6.
Think about the supply difference, though. When supply was 3 times what it is today.
So my question was, do we think that was the big difference in the spread between 6 and 7 was new builds? Is that mostly why it was larger? Was the amount of new builds that
and just
were
more
going
people
up?
transacting at the same time. There were more people selling. There were more people buying. You had a much more balanced market, but just more people in the market. And so it didn't feel as chaotic because it wasn't everyone fighting over one house. It was everyone picking their partner, and there were enough partners, and it all worked. But there were a lot of people active in the market. You could Dodd-Frank though, so it's just everything's different.
You could argue the demand today is probably not too dissimilar from what it was then. It's just a supply side issue.
If the interest rates were at a level that people felt comfortable, you'd probably be able to get there. When the rates were like 3%, if there was supply for it, we probably would have eclipsed 7 million pretty easy. But there was just not enough supply to get it there.
And why was there not supply in the middle of COVID though?
There's not enough new construction because what happened is all that stuff that happened in 05, 06, 07, and 08 freaked the heck out of the builders, and they built like millions less homes than they should have between 2010 and 2020. So not only are those homes, did they not get purchased, but they also aren't getting resold now either. So you just have a lot less sticks sitting on dirt than you should have right now.
So then in 2006, 2007, the Fed ramped it up. They paused it.
Yep.
What happened when they paused the overnight?
So when they announced the
increases?
pause in this time frame, rates retreated for about 6 months. They went from 6.6 down to about 6.1%. So we did see about a 50 basis points pullback. Prior to the crash 2008, they had pulled back even a little bit further, got about a low as 6%. But you're talking about, going from maybe the high sixes down to about the 6% range. So, I mean, if we want to jump ahead to, what it means for today.
Yeah, compare that.
Yeah, when the Fed pauses, which will, like I said, likely happen in their next meeting, interest rates should start to stabilize and then start to retreat, similar to what happened in 2006. I don't see as big of a pullback as kind of what we mentioned in our lead-in, which was like the 5 to 5.5 range. I could see it going to the 6.5 range by kind of the early part of 2024. That seems reasonable. And if they do start cutting rates back, it'll push back faster. But I think a lot of us at this table believe, I don't know that they're guaranteed to just start pulling rates back on the overnight rate versus just leaving it where it is and hoping the economy continues to trickle along for a period of time.
So you're saying if the Fed in, let's say 2006, 2007, they paused, it fell back like
50 basis points.
50 basis points. You think if they pause now, it's going to be about the same?
It's hard to, it's hard to guarantee anything.
We don't have a magic 8 ball. I'm just saying, like,
I
that
think
would
once
be
they
what
pause,
happened,
bond rates will come down, and that will lead to mortgage rates coming down.
which
I'd
is
say,
about and 50 basis points.
yeah, you
put
could see
at, like,
6.5. Yep, pretty reasonably.
Yep. And unless they, if they start to lower the overnight rate, obviously that's going to then have a greater impact on them going lower.
I think, but the other thing to keep in mind is the way in which they raise the rate and in the way in which they're going to either hold it or cut the rate potentially here. You can see the Fed is, this is what we've talked about. This is, potentially we had a recession already, or we're entering one, we're going to have one, whatever, right?
I'm not sure those exist anymore.
I don't know what the term is. But in that time period of 06, 07, when they raised the rate, they only did a quarter point at every single meeting. This is like the first test of information and technology in central planning to see if they can actually avoid potentially a hard landing, if you will, like they've talked about. Like they can avoid catastrophe by noodling this rate and threading it in the perfect way. And so it's going to be hard to say if using history to kind of calculate out where this is going to go is going to be useful or not, because I think we talked about this morning, the last time they raised the rate 75 basis points at one meeting was, I believe, in 1994, November 15th. They did it 3 consecutive times last year. So, this is different than what we've ever seen. And the rate went from 0 to 5.5 within 14 months. And it took how many 25 basis point increases between 06 and 08 for it to get to the level it was at then? It was over 2 years. So you've seen this kind of slingshot. The rates went way up. The real estate market kept kicking along. So what are they going to do from here, right? Are they going to cut it by 75 basis points at some point if they see something? Or are they going to use that slow burn 25? Because they've shown they're willing to raise it that quickly.
I think the difference here is they're deathly afraid of inflation, right? And the overall state of the market, you look at jobs, you look at the stock market, you look at the actual CPI numbers that are coming out now, seems pretty okay. So unless they see something in the data that says things are really bad and they hit it too hard, I think there's a high likelihood they're going to kind of stay put, right? I think the example I used this morning, we were talking about this because we're house guys, is your house is at 66 degrees right now and you have a furnace, you probably should turn the furnace on because the house is at 66. You want it a little bit warmer. But if your furnace is on the fritz and there's a chance that you feel like when you turn it on, it's going to go to 80 degrees or there's a possibility it goes to 80 degrees, you're probably just going to sit still at 66 and be comfortable.
Yeah.
Right? Like, and that's what I think the Fed is looking at this is saying, the numbers look okay. Like everyone's doing pretty okay. Let's not mess with this too much. So that's my hypothesis for the next 12.
Something would have to break.
I don't see. I see them acting very conservatively right now. I don't see a 75-point decrease as large, but I could see. I mean, when the Silicon Valley Bank went belly up, and they were worried about the other banks, there was a lot of talk around the fact that they were getting concerned that they had raised it too high too fast. So if they saw something like that, maybe.
But were they concerned or was everyone else concerned?
Maybe
they never really said much about it.
Maybe it was just everybody else.
It took them in the housing crash, another fun stat for you guys out there. It took them 10 meetings over 15 months to take the rate from 4.75 to 0. The final cut being in December 16, 2008 of 100 basis points.
At the same time, European banks were negative during that period.
Yeah.
So,
pretty crazy.
So anyways, that's kind of my hypothesis.
Yeah,
And
sure.
So if you think about this, I think the history is important because it kind of tells us what kind of happened and it gives us some barometer for a comparison point. Now, the reality is AJ's right. The market is so different today. The lending standards are different. The rules are different. The data, the technology, all that's different. Yeah. So it's not going to behave exactly the same way. But I do think that it's important to at least point out, like, we have a lot of people just basically betting their next year on, well, rates will come down and everything will get better. Rates probably will come down. I think, like, when we looked at this 2 years ago, we were saying the same thing about rates going up. Everyone's like, are rates going to go up? We're like, yeah, they're going to go up. We don't know how high they're going to go, but they're going to go up. Now, I would have probably told you I would not have predicted 6. I wouldn't have even predicted 5.5 2 years ago. So it went up more than I thought it was going to. But when I look at this, I think the range is probably tighter than most are predicting in terms of how far they're going to come down. Meaning they'll stay closer to where they are today, then you'll see a 150-point drop off a cliff.
And again, I would argue, depending on your opinion, it probably is better if they stay around 6 for a longer period of time than if they in 12 months were 5. Because if they go to 5 in 12 months, it's going to go crazy again and prices are going to start to appreciate it, which maybe isn't the worst thing ever, I guess. But from an inflationary standpoint, it's not great. From an affordability standpoint, it's not great. It would make the market difficult for buyers.
We've talked about this for a while, and consistency in a rate environment in any market where loans are the norm. Car prices freaked out, right, in that time period too. Mm-hmm. Consistency in rates leads to a more stable marketplace in any sector of the economy. So whether that's real estate, car prices, even personal transactions where credit card rates are different, all of that is largely impacted by large swings in rates. So having them, to your point, the ideal scenario here is these rates go down by less than 1%, mortgage rates, I mean, by less than 1% over a 12-month period of time, and they get into a place where they're in a more historical norm, which we've talked about is probably somewhere with a 5 in front of it, but that they don't just go to 5 in 9 months.
This is a super random, but Caitlin, who you know, my wife, for those who don't know, bought a Kia Soul in like 2018, 2019, and in 2021 sold the Kia Soul, which is supposed to depreciate quickly, for more money than she bought it for in 2021. And I was shocked. Drove it off the lot, drove it back with 10,000 more miles and made money.
Great investment.
It was,
but then you bought your next car and it had gone up equally. So.
Exactly. Yeah, it doesn't make a difference.
That said, so the only caveat I'll throw in this is because it's a podcast geared mostly towards real estate agents. If rates come down slowly, activity will continue to be more similar to what you've seen this year, right? So yeah, you're arguing if we go down too fast, everyone will freak out. We'll have too many people in the marketplace, et cetera. There is a point though at which the lower rate benefits us because the sellers get to the point where the math works again for them to move. And so right now, the gap in the spread is causing all of the problems we're seeing on the supply side, or the bulk of the problems we're seeing on the supply side. And so I don't know exactly where the tipping point is, where a seller looks and says, well, if I go from 3.5 to 5.5, that's okay, right? But 3.5 to 6.5 probably isn't. 3.5 to 6 might not be. Where is that number?
I think I know the tipping point. The tipping point is going to be the number at which if they rented their current house and bought a new house, that the cash flow on the rent covers the difference in the interest rate spread, or at least close. So
But that makes the market worse.
it does. But that's if rates go to 6 or let's say they go to 5.5 in 2 years. And I have somebody, for example, I was golfing with him last week and I said, what's your interest rate? They have a 3-bed, 2-bath split level in Eden Prairie. Or sorry, not your rate. Their rate's 275. I said, what's your payment? They bought it in like 2020, 2021. He said it's $2,000 a month.
Yep.
And I said, so if you move in 3 to 5 years, you should never sell that house.
Yeah, but that said, let's say the rate's gone to 5, right?
Yeah.
So then the valuations go way up.
On their
So then
current
the
house.
equity goes way up. They can sell it and make a lot of money on that. It's not necessarily, and then the rents will also move, but maybe not accordingly.
But if they can rent that place at $3,000 a month, let's just say in 5 years,
Yeah.
and their payment on the next place is only $1,000 higher than it would have been if the rate was 4 to 5.5 a month.
Yep.
And they can make $1,000 in cash flow, they're better off just keeping it, and it makes sense to move financially at that point.
Yeah, but then you're not going to fix the problem. You're going to create a double problem.
So from a market perspective, it's a problem. I understand that.
Yeah,
I'm
I'm
just
just
saying that's what will push people to do it. They'll be able to cover the spread.
Unless the equity growth is sufficient for them to say, well,
I want the money.
forget renting. I'll just take my cash and I'll pump it into the next one and buy a bigger house.
That would be the only thing that I could see them still selling that.
Yep. It's a fair
that
point, though. But that we're going to have some point in which a seller looks and says the gap is no longer sufficient for me to justify not moving. And so I don't know what that point's going to be, but the rates are going to have to get down closer to 5, I think, before we see the supply side start to try to even out.
I will say too that most people, while we are in rental real estate, don't want to be landlords. And I've asked people if they want to do this, and I've tried to help them.
There's a
do
lot
it,
of days
and
where I
they
don't want to be a landlord.
There you go. If you have a client, as a side note, that has a single property and they don't want to be a landlord, but it makes a ton of sense for them to rent it out, and they're looking for a property management company that provides the best possible service, Hive Lane Property Management is coming soon in 2024. Send us a DM. That's a serious plug. We are working on this right now. But I have one bold prediction I want to throw out there. Rates get to 5.5, let's just say, and people figure out that since they can work with Hive Lane Property Management, they can rent their current property and buy a new house. And so because I think that rentals are going to increase in the Twin Cities. I think that number is going to go up because I do. And I know people don't want to rent them, but I personally believe that the person at 275 might be forced to rent because it's so hard to get rid of that rate. If rentals do increase, could we see oversupply on the rental side in the Twin Cities area, which causes rental prices to go down?
I think we would need to have a massive amount of change for that to happen.
That could be a good future podcast topic to look at the amount, because there's a lot of commercial buildings going up for apartments, and there's a lot of other commercial buildings that aren't really as usable anymore because of the changes to the way we're working, and there's potentially additional supply there too. So yes, the potential supply on the rental market is significant. So it is a good question to kind of ponder how that impacts rental prices in the
Possibly
future.
not significant enough. Well, that's a random finish, but that's all we have this week for the Nerdy Agent Podcast. And remember, be better.
Bye-bye.